Well, hello, everyone. I see the participant numbers coming in. We so appreciate you spending your Thursday afternoon with us. We will be getting started in just a moment, letting everyone get settled. So hopefully you are winding down and you are all healthy, well, and in place. So this would be the time to get comfortable. You're going to get a lot of valuable information. So if you don't have a pen, paper handy, your notes on your notepad, however you want to get this information, have your tools ready. This will be a session that is recorded. So if you miss anything, it will be available on our website. So we want to give everyone an opportunity to get settled, and we will be getting started momentarily. And Simone, when you start seeing kind of a lull in the attendees, let me know, and then I'll give me a cue to get started. Okay. Well, others will probably be joining us, but I wanted to officially welcome you. My name is Nikki Beasley. I'm the Executive Director of Richmond Neighborhood Housing Services, and you have entered our Money Matters series, where we're going to talk to some real estate professionals talking to us about what's going on in the real estate market, primarily around home ownership for buyers and sellers, and specific to first-time home buyers. Around this whole COVID conversation. Hopefully we can unmask the real truth, address some of the concerns, but then demystify some of the things that you may be hearing. Our organization has been around since 1981 with its sole purpose of providing affordable housing to low to moderate income families. But along that path, we are also a HUD-approved counseling agency that provides the education, which this falls under, educating individuals of how to become homeowners. We provide the pre-purchase workshop that's HUD certified. So if you are a first-time home buyer and needing assistance, whether it's down payment or subsidy, oftentimes your lender or program will require you to go to a class like ours. And we're actually going to be hosting our pre-purchase workshop via Zoom in the month of June. So if that fits what you need, be sure to let us know. We're also infill developers. We are building a first-time home buyer home ownership project in West Oakland, 7 single-family homes. Our mission is we want to get you approved, but we know a lot of folks can get approved, but they can't afford. And I'm hoping this conversation will enlighten us that that may be shifting and changing. But in the long run, we wanted to have properties that we could hold so that people would have the ability to afford. And we're also property manager owners of single family and multifamily properties that we make available to low to moderate income families. And then lastly, a lot of our work falls into advocacy, where we look to address the concerns of tenants, consumer rights related to the Community Reinvestment Act. We won't be talking about it today, but that is critically important for you first-time home buyers, because that's what the banks are required to do to make these programs available. And for many of you may not know, there has been a realignment of CRA, which could be somewhat detrimental to folks like us who need capital. So we've been aggressively working against some of the detrimental changes to the Community Reinvestment Act. So with all that, this is what we do. We have Simone Gorey here, who is our property finance manager, who's going to be my co-pilot through all of this. Tisha is also remote, who you've probably connected with either through your registration or questions about, our programs. So we're just happy you're here. And I wish we were doing the meeting piece so I could see all your faces, but I'm claiming you're all healthy, you're well. And without further ado, one last thing, because I don't want to assume everyone is on 10 Zoom meetings today, like most of us, but if you're not familiar with Zoom, at your bottom panel, That's where we're going to be most engaged. You have your mute, which we have everyone on mute. Video doesn't matter because it's a web piece, but it tells you the number of people that are in our presentation. The question and answer, I really want you to be interactive as speakers are having their conversations. If questions come up, please put your questions there and we will start asking questions in between. We may be engaging with you in the chat function, answering some of your questions. And then lastly, this will be recorded. So if you want, again, to get access to this later, you'll be able to find it on our website. So now that we've gotten all the housekeeping, glad you're here. Want to first introduce one of our partners, Rhea Cotton, who is a realtor who's going to kind of kick off our conversation. She has participated in our Changing the Narrative event that we host every year. She's also done other money matter topics. So we're happy that you're here, Rhea, and really looking towards your expertise to tell our audience what is happening in real estate as it relates to this COVID-19 pandemic.
Thank you, Nikki. Hello, everyone, and thank you for joining us. My name is Rhea Cotton, and I'm the broker owner of Cotton Realty. I have a real estate company that spans across a few different counties, Alameda, Contra Costa, and Solano. We are a virtual company in that we meet and collaborate with agents across counties. And this allows us to collaborate for home buyers that aren't necessarily purchasing in the cities of which they do business and live, and that are possibly commuting outside of their area. So we're collaborating together as real estate professionals in doing that. And so prior to being a real estate broker, I started in mortgage in 2004. So I'm glad that we're here and we're having this conversation because I've seen the scare of 2008 when the market crashed, and this is a totally different environment. And so I'm really excited that Nikki has invited us here to share some positive things that are going on in the market right now for home buyers. In addition to that, I'm also president of Women's Council of Associated Real Property Brokers, and we are an African-American organization rooted in democracy and housing. We do collaborate with neighborhood housing services in order to do home buying workshops as well as financial literacy. We provide scholarships as well as educate other women on real estate development that are not necessarily in the real estate field. And so I want to allow Shaniqua to also introduce herself. Hey, Shaniqua.
Thanks, Rhea. My name is Shaniqua Badger. I am the owner of the Badger Real Estate Group. We are a full service team that covers most of the Northern California. We span all the way from Santa Clara County, which I am a native of San Jose, all the way up through San Joaquin County, which I'm also a resident of, but my office is actually located in Oakland, California. I've been celebrating 15 years in real estate this year, and I like to say that I've gone through micro cycles of real estate, which has given me a lot of levity in being able to help people in different stages of the buying and the selling stage of their own real estate cycles. A lot of my clients this year are getting into their second and third properties based on the initial conversation that they may have had with me five or 6 years ago. So to be able to help people grow, not just the place where they live, but their real estate portfolio so that they can build generational wealth is really a warm spot for me because I started off working with buyers on a first-time home buyer platform that I built as a new agent 15 years ago. And that, buyers are still a very warm and fuzzy spot for me. The other thing I like to make sure that people are aware of is I too am a part of ARPB. I've been a part of ARPB for the last 2 years, but a part of the National Association of Real Estate Brokers throughout the span of my real estate career. The National Association of Real Estate Brokers is a national organization that was started in 1947. That was started because people of color were not allowed to join the realtors. And so we had to create our own space to not only just advocate for people who were real estate agents, but people who were trying to buy and sell real estate, because there was not legislation that helped us protect our ability to be inclusive in the real estate space. So we had to kind of kick open our own doors. And today, we've seen us be a part of the Fair Housing Act. And then you fast forward to today where we're still creating equitable spaces for buyers and sellers. So we are, both Rhea and myself can say that we advocate for buyers, we advocate for sellers, we advocate for people who are looking to make sure that they are trying to pave a way for generational wealth in the real estate space. So I'm excited to be here. I'm happy to be here. I love doing outreach. I always say sometimes, we have to come to where people are. And so today is one of those days. So I am all ears. I'm ready. So let's have a conversation about the COVID climate in real estate.
Yeah, Shaniqua, so let's reverse for a minute. That first week that they started announcing the shelter in place, so beginning of March. So when I heard that on the news, the first thing I thought is, people are always asking, when is the next recession going to hit? When is the market going to crash? And so when I heard about the shelter in place, I'm like, oh, here we go. People are going to think that the market is crashing. And so one thing that I want to distinguish is the 2008 market versus today's market. And I want to get your thoughts on this, but my thoughts are, in 2008, we had stated income loans. We had people basically qualifying for properties where they were not verifying their income and comparing their income to their debt, and not qualifying properly for something that they could really afford. And so when the mortgage crisis hit in 2008, it was, one, easy for people to walk away because they weren't really attached to it. They thought that they could flip a property real quick by buying it. They didn't have any money invested in it, versus now where we have people that have to qualify with full income. They have to invest money into their property. And so the climate right now versus where it was in 2008 for home buyers is a little bit different. What are your thoughts on that?
Oh, vastly different. I think people need to understand that there's two different conditions that we're looking at here when we're looking at today's real estate market in COVID-19 versus what we saw in the foreclosure crisis. Now, I think that all of you, there's a lot of people that come to me and think that they're going to get a rollback special when it comes to real estate. The Bay Area is going to go on sale.
Right.
And I don't think that's necessarily going to be the case. And let me explain to you why. So we have two vastly different conditions. And yes, real estate does go through cycles, and we were about due for a cycle, but no one thought that a super germ was going to come and be one of those cycles. So we have to understand that there's a difference between man-made and God-made conditions that we're dealing with. The first condition is people were not in a position to buy properties that were extended money to be able to fund and buy properties. So we were seeing people that were buying properties that were working at McDonald's, making minimum wage, buying 5-bedroom properties out in Antioch. We were seeing a lot of fraud in the system, not just on the buyer side, but also on the practitioner side and on the lending side. So you have all these man-made influences on the stability of the market, and let's also take into consideration that our interest rates are night and day too. So the interest rates right before the foreclosure crisis were anywhere between 14 and 18%. Today, people are getting into home ownership anywhere between the high 2s and the low 3s, depending on whether or not you have a down payment assistance program attached to that loan. So you don't have as far to fall. And you have way more stability today than you did back then. Back then, we had loans structured vastly different. You had what we call a balloon payment. Hey, 5 years, interest only, and then all of a sudden, you get this balloon payment where you started off paying $900 a month for 5 years, and it was a party until you got that $5,000 note 5 years later, because all of that principal got tacked on to the end of that 5 years. So it is vastly different. We see people that are now in a 30-year fixed. So the conditions are much different, and the environment in which we're selling real estate is much more stable than it was back in those days. We had, during the Obama administration, the CFPB came in and started regulating how credit was administered to people, bringing in more protection on the lending and on the buying side. And then we also saw a lot more guidelines and restrictions with the bank about how they were going to extend lending opportunities to people. So there's been a lot of things that have changed. Well, do I think that we'll see a shift? We may see a slight one, but we're not going to see people get houses on rollback, or it's not going to be like a white flower day sale.
Right, right. And I also like to remind my clients that an investment in property is a long-term investment. And so you're in a 30-year mortgage, and it's cyclical. So anyone that's stuck to their mortgage, truly qualified and could afford their mortgage in 2008, they're winning right now. They're refinancing into these 2 and 3% interest rates, maybe a 15-year, 10-year loan, and they're excelling because they rode the wave of the cycle that is real estate investing. And so, so now when the shelter in place first hit, I saw tons of properties drop off the market, so temporarily withdrawn. So the Association of Realtors allowed agents to withdraw their properties from the market temporarily so that the days on the market don't add up for them. But what that did is that dried up our inventory, and for the buyers that were still out hunting for homes because they weren't stopping, everybody wants to take advantage of these low interest rates, the inventory is actually drying up because people are withdrawing from the market, well, realtors and their clients. And so what I see is there's this shift now to virtually marketing your property on the market. And for real estate professionals that don't know how to virtually market a property, or they're just putting it on the MLS hoping that it will sell, they're being tested right now, because it takes more than just putting your house on the MLS. We're doing virtual tours. We're increasing our social media ads, and so it's getting. So at the beginning, I'm starting to see properties come back on the market, I think over this last week or so. But for the last 2 months, it had really been a tight space, even to the point where I would actually go on the MLS and look up withdrawn listings and encourage the listing agent to entertain my buyer's offer, because I knew they still wanted to buy a house. They just didn't know what they were going to do to sell it. What do you think about that, Shaniqua? About the...
Yeah, absolutely. It greatly affected our inventory, and that is actually a testament of the next conversation, which is, or my previous point, which was, you're not going to get a deal, because with the inventory tight, there's a demand for properties. There was a pent-up demand before we even got into the COVID crisis. And then now you have all these buyers that have all of this opportunity to move forward on a property with these super low interest rates. And then all of a sudden you have a multiple offer situation with people that are still overbidding just to get their foot in the door. Exactly. So that does greatly affect the values, because even the first month of the shelter in place, we were still operating at 70% of the market. That's not horrible. We did not see a tank, not one bit. That is very slight when you look at what could have possibly happened, especially considering the economy that we're living in the Bay Area, which is a pretty strong economy, but it really does talk to the resilience of the economy. But yeah, I do think that it was very interesting. I recently just closed, on Tuesday closed on an off-market duplex that I had to use the same kind of tactic, which was like, hi, buyers, don't you want to sell? I know you do. Get approval. So we really did have to work at it. And Rhea is right. The agents who are not pivoting in this market, that are not moving forward into a virtual space. I've always been a virtual space. and I just didn't realize I was virtual, but I've always kind of been virtual because I've never really set foot into my office. I have office space in Oakland, and I never go because I'm either out in the field or I'm talking to clients.
Right.
Really literally can talk to clients wherever I'm at. That's the great thing about being mobile with our laptops and our tablets and our smartphones. I tell people all the time, my smartphone makes me way smarter than I actually am. But being able to really pivot, being able to really gain exposure to your listings. I immediately went into virtual tours on my listings. It really did change the game. And guess what, buyers? Now you need us because you guys can't just window shop. I know all of you over there that are in the participant fields. Window shoppers when it comes to open houses. Now you guys need us. You actually have to call us because we're the ones that have the ability to pop open the locks and let you in, because now the city of all the counties are allowing us to actually show properties that are occupied and also that are vacant. So
and might I add, Shaniqua, to that, the new Corona addendum can require that you show your pre-approval before you even access the property as well. So, so you have to be really ready, and it basically takes out the looking portion of what of going to open houses over the weekend, because the Corona addendum is saying, hey, have your pre-approval ready.
Well, and to be honest, and this is an area of transparency, I know from me and how I operate my business, if you want me to leave the comfort of my home, and I'm an introvert, but when it comes to real estate sales, I'm a totally different person. But if you'd like me to leave the comfort of my home, you really do need to be pre-approved. That is just the honestly goodness truth. I think that's the standard for most agents. We are not into just popping open lots. We really want to make sure that when we are putting people in a position of buying, and we're taking time out of our schedules where we can either be allocating that to family or allocating that to other clients. We want to make sure that we're working with buyers that are pre-approved, because when you are pre-approved, not pre-qualified, but pre-approved, you have buying power. So it really allows us to understand exactly what you can and can't do once we're working with you as a potential client.
Right. So it looks like we have a couple of questions. Let's see. Where do you see equity in the Bay and California going forward? Well, I would like to say it's up. We have the benefit, and which is of being in a highly desirable area, as far as business, as far as living, as far as quality of life. And we also see that through our rental market. So as rents increase, the need and the desire to invest in the Bay Area market will also increase. Shaniqua?
Yeah, and I think what we're also going to see is, we've heard these large corporations basically are starting to give green light to work from home and be virtual. And I think what that's going to do is it's going to drive a lot of people to say, hey, I'm 100% virtual. Maybe I'm driving into the office once or twice a week. I'm okay with doing a commute. So people are likely to start moving into areas that are more affordable, that are giving them a bigger footprint, moving into areas like San Joaquin County and Merced County and things like this, because now you have the ability to be virtual, and we're going to see corporations start moving a little bit smarter when it comes to how they manage their human capital. And one of those things is like, hey, we went into shelter in place, people started working virtually, and nothing blew up. So, we might want to, run a little bit leaner and allow all of the people that work for us to go ahead and work virtually. So I think we're going to see that. And I also think that we're going to see the demand be very consistent in the San Francisco Bay Area.
And I wanted to chime in, something piqued a thought for me. when we talk about equity, and to I think one of the points that maybe Ria made, that when we're doing our classes, we always talk about there's never been anything wrong with the tool. It's how you've used the tool that has been problematic. So let's take the mortgage industry in '08 and '09, all these crazy loans. A lot of folks were getting into the wrong type of loan to protect their asset. So fast forward to where we are now, there's never a material loss. So to the point, if you bought your house in '08 and it's now 2019, 2020, you might have had some peaks and valleys, but you're on the uptick. It's only when you decide to sell that that is your material loss. But when we look at equity and we see how many communities have been built to inflate value, was with the anticipation of this new employer market, bringing all these people in, the techies and all of that. But now with COVID-19 is definitely going to shift, where people who had no alliances to these communities are now going back home because jobs are shutting down, or to the point now they can work out of Massachusetts. They don't necessarily need to be in downtown Oakland or San Francisco. So there may be somewhat of a slight shift in property value because all of the things around them are no longer producing, like restaurants, stores, retail, all of that. But the other thing, and looking at the poll, many of you are first-time home buyers or have an interest in home ownership, is also understanding these areas will also take a new face, because we've all heard of the word gentrification. So now areas that were very desirable may shift and change again because you don't have the nuances, but also pay attention to census tracts, because there's some questions in here about how do you qualify, where are some down payments, and we'll get to that. But knowing that areas can also predict what type of support you can get as it relates to getting into a home.
Definitely, definitely. And Nikki, your office is in Richmond, and in the North Richmond area, there are a lot of developers that are working to build on the land available in the North Richmond area, and that is considered in the low to moderate census tract areas. So people are able to benefit from things like the programs that have no PMI because you're in a low to moderate census tract, which will save you a couple $100s a month on your mortgage, because it's in this program, but you're getting brand new homes. It's a development that is transforming, and so it's really exciting to see and where it will go over the next 10 years.
And the last point I'll make there is this. When you buy in a census tract, the income limits for many of these programs are unlimited. So you could be making $1 million moving into a census tract area, which is undesirable, not a lot going on, which was redlining, and you could qualify for the same benefits that many of us that are not making nearly as much that want to be in more desirable areas. So you really want to, again, work with real estate agents that are understanding the way to maneuver and strategize. Another part of our work is uncoupling race and income, because low income, moderate income, affordable housing is a code to say that most people of color are assumed poor and that they don't have a lot of money. But we know there's a lot of us making good money that may exceed these minimum income expectations, but no, there could be another way to get into a program if you're making too much money.
Did you, Nikki, want to go over the other questions that came through?
Yeah, so one came up about, can I find a deal in Oakland? So is it a, blue light special out there?
No, I think if you want to find what you would consider a deal, I think that you really need to figure out what the financial strategy is. Because to me, you're looking in for move-in ready in a great location, you're not going to find a deal there. But where are the deals where are the areas I think that you'll find the deal? So there's the area, and then there's the financial strategy. So for me, I'm always telling people, like, go buy up East Oakland. It's in the heart of the opportunity zone. Your home value is going to benefit over the life of the ownership. So you should really focus your search on East Oakland, because that's really the last affordable place.
Mm-hmm.
the affordable footprint in Oakland. But then the second thing is I think a lot of us overlook properties that are in disrepair. And when I say disrepair, I mean like, hey, it's not a pretty house, it's the ugly house, right? And honestly, those are the houses you want to go for, because you can find an ugly house in a great neighborhood and transform it with a 203K loan. So I just recently had a client go and find an ugly house in a great neighborhood out in Fruitvale. And they literally put $150,000, I think $175,000 worth of renovation into that house. And they're looking at really a brand new house and restructured it a little bit. And so what they bought it is completely different from what it's worth now after it's been renovated. They're actually finishing the renovation within the week. But these are the opportunities that you have. So, I always say the houses that I love the most are the ones that are completely burnt out. Burnt down, not burnt down to the ground, but just as long as it has like the foundation still intact. Those are my favorite, because you can do whatever you want with them as long as it stays the same, floor plan with bedrooms and bathrooms. You can build whatever you want. So,
and Shaniqua, can you talk a little bit about the financing option for that type of fixer-upper mortgage?
Right. So let's say, and I'm going to use a really good example of a home that I showed to a client in East Oakland. And I don't mean deep East Oakland, like by the Coliseum. So the house was completely burnt down to the ground. $99,000 is what the offer price was. But the repaired value, when we say repaired value, we're looking at the value, move-in ready, you can open the doors, fully functional, repaired value. So if you were to go and completely restore this house, the house at that time was worth $475,000. So imagine being able to have $300,000 to play with and really build the house that you want. And this is tied into the mechanics of the loan. And what I really like is you can go in and do things like, hey, the foundation is in disrepair. And we see a lot of foundation problems in the city of Oakland.
Yes, definitely.
We see properties that have been a part of people's families for 30 and 40 years, and may be in some sort of disrepair. And they're really kind of selling it at a below market value because it's in disrepair. You can go in and then go and renovate it and create the house that you want. With these loans, that's a 203K. 203K, you can buy it for 3.5% down. Now, listen, if my client would have moved on that $99,000 property, they would have bought it with 3.5% down at $99,000. So you tell me how you're not winning when you're able to go in and create these. And you know how you have all these yellow signs that say we buy ugly houses? Y'all can buy ugly houses too.
Right.
And it's all about the strategy around the financing and the location, and you can really make that work to your benefit.
Shaniqua, I also want to add too that with all of the changes for investors in private money or hard money financing for investors, they had a shift as well. So for investors that come in and want to purchase these ugly houses, their return might not be as great right now as they expected because one, their interest rates are going up while your FHA loan is staying low. And two, they already have their strategy in place and they have a return on investment that they are looking for. And so now they're required to invest more that they didn't plan to invest into these properties in order to flip them. And so but then they also need a return on investment. As a homeowner, your return on investment is going to come over the next 30 years as you are living in the property. You don't need to make your return over the next 6 to 9 months because that's as long as investors may usually have to renovate the house and then sell it. And so a lot of these private money lenders slowed down on their financing because they were concerned. How long are we going to be sheltered in place? If I give you $500,000 to renovate a house, how do I know I'm going to get my money back in 6 to 9 months? I don't know how many buyers are going to be out searching for this property. I don't know where the market is going. So when that shift occurred, I was just like, oh my goodness, this is the time. Like where you are outbidded by all cash buyers, here's your opportunity to come slide in, get your 203K renovation loan and make and make an opportunity for yourself where you were previously outbid by all cash buyers.
Yeah,
And I think this is a good segue to another question. So what we're talking about right now, the 203K loan is not necessarily under the first-time home buyer umbrella, but does not mean if you're a first-time home buyer, you would not have access to it. So I want to just give you a generality of what it means to be a first-time home buyer. It means that your credit score typically, depending on the lender, and again, some of these have shifted and changed through COVID, is under 640. You may not have the 3.5% down, and you would need assistance in getting the down payment. Now, if that is not your situation, you have money in the bank, you have a credit score that's 680 or better, then the 203K could be a potential. And I think that's where we come in, is assessing where it is you're trying to go. And because of our knowledge and expertise, structuring something that works for you. So we don't want you walking away from here thinking that whatever we're talking about doesn't apply to you, because until we do a deep dive conversation, we don't know what will and won't work for you. So that comes up to the question of interest rates. Does participation in a down payment program like WISH result in a higher interest rate? I'll put my 2 cents in just because of the work that we do, and if you guys have any insight. Interest rates are always going to be determined by the bank, so I'm always going to say it depends. By having down payment assistance doesn't always mean that you're going to have a higher interest rate. So it depends on the loan packaging. And if you qualify with low debt, 20% down, what is the lowest interest rate generally available? Can we expect to see a rate below 3%? So again, it depends on the loan, it depends on the product, it depends on your credit score, it depends on your down payment assistance. Interest rates are typically indexed by, is it the T-bill? I want to say the T-bill. So as that changes, as the federal government does their economic shifts, that's what's going to indicate the interest rate. But do you ladies want to talk on anything related to down payment?
Well, one thing that that I see that is pretty common in most down payment assistance programs or first-time home buyer programs is that the interest rates do not fluctuate by credit score like it would with a conventional loan. So, so as you're working with programs such as Richmond Neighborhood Housing Services to get qualified and be prepared to become a new home buyer, the benefit of working with first-time home buyer lending programs is they set a minimum based on lenders, so it varies. They set a minimum of what the credit score will be, and then once you have exceeded that credit score, you'll get the same interest rate as if you were, let's say if their minimum score was 640 versus a 700, you are taking advantage of an attractive interest rate. And so as far as down payment assistance goes, that's basically layered on top of those programs.
Anything you wanted to share, Shaniqua, before we go to the next question?
Yeah, I mean, I definitely would say to somebody who wanted to entertain a down payment assistance program, yes, you should shop it. Should you shop as a consumer? Yeah, you should understand kind of how interest rates are going to affect you and affect your mortgage, because at the end of the day, that's where it's going to affect you the most is your mortgage. But you should also understand that one it's not a cookie cutter type of a situation. So I have a lot of people that say, well, my friend got, and understand that your friends are always going to have access to different programs. They got different credit scores, they got different DTIs. And so don't be afraid to not use the down payment assistance program, because even if it does make the interest rate go up just a little bit, because at the end of the day, we want to make sure that you're leveraged. So what it does is it gives you leverage to make a movement once you get into the home. What is leverage do to you once you get in the home? All of a sudden you have access to equity, because the longer that you sit down and try to rationalize what you can and can't do around numbers, 9 times out of 10, if you cost yourself $20,000 or $30,000, just kind of over analyzing something where you should have created movement in your finances. And so I always like to have these conversations like, listen, your interest rate may have gone up a little bit, but let's compare it to different times of our existence where it was 15, 16, 17, 18, 19%. And right now we got shit about 4.2.
And I think you bring up a good point. What I always say when I was in finance is it's financial DNA. What works for me is not going to work for anybody else in this conversation, and vice versa. So you really have to go through the process to understand what you're trying to accomplish. So that goes into the question of, are we recommending as a first-time home buyer to buy a home in disrepair? I'm saying I'm not recommending it, but it'd be worth having a conversation. And because I'm not recommending it, it does not mean that it's not something you do. I don't have enough information to say that's the thing to do. Right. So as you're going through this process, you want to be able to talk to someone either at an organization like ours or a realtor to really have an invested conversation to understand what the end goal is, to determine how to navigate you through the process.
And Nikki, I just want to add too, and that's why I always recommend that people work with HUD agencies such as yourself, because it's it's like a neutral third party that can direct you along the right path. So I hate to hear that someone gave up on home ownership because they went to Bank A that told them they needed a 700 FICO or credit score to get an FHA loan, when right across the street was Bank B that only required a 620. So when you come to a HUD counseling agency, you're with a neutral party that is going to direct you safely into a path that fits your picture as far as the finances.
And I'll make a mental note to share a little bit about our lender program that supports just what you shared. The next question is, and I'm excited to hear your response, I think I know what it is there value in waiting to the end of the year or buying sooner?
Is there value into waiting for now versus the end of the year?
Yeah, should you wait or should you try to get into a home now?
Shaniqua, you want to go first?
Well, I'm gonna give you two.
We talked about this yesterday.
Yeah,
we knew this question would come up.
Yeah, I'm gonna give you two different answers. So the number one, I always say you buy when the money is cheap. We know what the interest rate is today. We won't know what it is towards the end of the year. Now, I can tell you that I love shopping for homes at the end of the year because everybody goes into holiday mode, and I'm the only one with galoshes on and a raincoat showing properties and pouring down rain. And guess what? Because you all are all distracted, I'm out there getting
in Hawaii, lounging,
going to the galas and the holiday parties and the whatnots. I'm out there putting my clients in properties while you guys aren't paying attention. So it really does depend. I really do think that at best you should make a decision based on financially what makes better sense, which is how much am I going to pay over the life of the loan? Now, you could sit there and have a conversation with yourself and say, hey, I'm going to try to wait towards the end of the year, but you may be playing against a changing interest rate. And how much is that going to cost you? And you can't just look at it at the right now. You have to say, how much is it going to cost me over 30 years? And so we make these decisions and it costs us, you'll see a differentiation in the loan, like, oh, my payment went up $200 or my payment went up $300. No, it didn't go up $200. It went up $200 over the life of the loan. So you really do have to understand where the money, how things are moving in the market in order to make a decision like that.
And here's what I will say from the rental piece and how we promote all of our home buying efforts is if you are paying rent in the Bay Area, 8, maybe 7 times out of 10, that could be a mortgage payment. So we encourage you to see if you could qualify. Because of the area, we're pretty unique. If we were somewhere in the Midwest or other places where the rents weren't so high, maybe not the conversation to have, but for what we understand, most people are paying, and when we do our calculation, a lot of times that's a mortgage payment. I wanted to kind of segue into the next question that I have that I think will be helpful to the group, is that as you're going down this path, can you talk a little bit about multifamily units and how that could be a alternative purchase for someone looking to get into homes, and do first-time home buyers qualify for those?
Yes, so multi-units, and I'm sure with Shaniqua as well, buyers are really motivated now to learn all of the opportunities and financing options as it comes to multi-unit. And just to go back to the previous question, is now a good time to buy? If you are ready and prepared and financially ready, as Shaniqua mentioned, to buy now, then now is the right time for you to buy. Towards the end of the year, you never know if let's just say the market takes a little dip, the guidelines for banks may change. So where you were able to maybe save $25,000 on a purchase price, you can now no longer qualify because the banks tend to tighten up their guidelines when the market is really attractive to basically manage their pipeline of how many loans can they push in and how many loans can they push out. And so then what they do is they restrict the guidelines in order to basically handle that volume. And so where you may be ready now, something may change in the industry by December where you're no longer qualified. So when you're prepared to buy, and it's always now, it's always the right time to buy if you're prepared and ready. As far as multi-units are, oh my God, it's so awesome right now that everybody is really open to the idea of being a landlord or even co-buying with family members. Because again, we're mentioning the FHA loan. With the FHA loan, you can purchase 2 to 4 unit properties with 3.5% down. There is what they call a sufficiency test that needs to occur, where they are basically looking at all of the market rents that you can receive from the property, and taking that amount and doing a test to see if you can actually add the income to your income. So not only are you qualifying with your income, you're also qualifying with 75% usually of the income that is generated from the entire unit, or projected income from all of those units together. So it's really opening the door for people to basically purchase homes and have mortgages less than what the rent is again. And so Shaniqua, you want to touch on house hacking?
Yeah, I mean, I that's one of my favorite things to talk about, honestly, because what you can't do alone, you can do together. And there's times when we have multi-generations living in our household, and you can really put that money together and start creating income. Especially if you're already living in an apartment situation now, why don't you live in a fourplex and really kind of maximize your profits as a family? And when we say families, I think the guidelines for FHA, which for FHA, you can have up to, I think, 5 people on the loan at one time.
Right.
We're talking about mothers, fathers, sisters, brothers, fiancés, in-laws too, partners, which means you can be unmarried and do this, and understand that you can get gift funds to cover your down payment or your closing costs. It's really quite flexible. And I think it's really kind of the smart thing to do, because if you're in a position where you're like, hey, I can't afford a single family residence. Well, guess what? You could probably afford a multi-unit, because they're going to gross up the rents and attach that to your income so that you can afford more purchasing power, and then really kind of play in the market like you should. I just closed on a duplex in West Oakland yesterday, and they're going to go and do a slight renovation on units, and they're going to do different investment strategies with those rooms that they have. But it's really exciting to see people just kind of say, hey, what are we going to do? We're going to live in one unit, and then what are we going to do with the other units? I closed on another property in San Pablo that was a duplex for a nurse, and she's like, bringing in traveling nurses for my bottom unit, and I'm going to live at the top. So
Right.
there's really so many things that you can do. And it's really about, when we're talking about capacity, it's really about helping you with capacity, because if, you know, your first home, you know, you're finding these homes that are $400,000, you really don't like them. Well, guess what? Now you can get a multi-unit. You can either offset your mortgage, or you can get cash flow at some point, which that will happen even if the numbers are tight. And then eventually leverage the income from that and go buy the house that you want for your second or your third property. So
Yeah.
it really does give you a ability to what we call leverage.
Yes, and I wanted to tie that in. So a couple of things. Typically, the first-time home buyer only stays in their house for 5 to 7 years. So to Shaniqua's point, their first house isn't going to ideally be your dream house. You just need to get in where you fit in if you are in position to buy. Because if you're able to ride the wave in the circle, 9 times out of 10 is going to be a good investment. The other thing is us being creative of how we qualify. So I want to answer the AC Boost question. So many of these first-time home buyer programs like AC Boost is going to be dependent on household income. So the more people that you have in your property are going to be participating in the expenses, that income could be utilized to help you qualify. So that is not necessarily a bad thing. So, and the other thing about it is that most first-time home buyers first-time home buyer programs do allow you to buy multifamily units. And you could get into a situation where you're doing non-borrower income, meaning that you're the only one on the loan, but if you've been having a roommate or, you know, partner, and they can demonstrate they've been paying some form of rent, they can help you qualify. So again, there's a lot of creative ways to get you to qualify. And the other question I wanted to get you to, going back to the 203 loan, can you explain how the 203 loan is implemented in the loan of practical purchase of a house? So John, I'm not sure if I'm understanding the question, but maybe you could just walk us through the construction portion versus the financing portion when you do a 203K, and how does that all work?
Okay, so basically, so basically they take, to Shaniqua's scenario, the $99,000 house. So they take the construction cost to build. So let's say to rebuild that house was $300,000. So then you have a combined amount of $99,000 to purchase the actual land and the burnt down house, as well as the $300,000 construction costs, which is a total of $399,000. So they take those two combined, and I believe it's usually they look at the after improved value, and those two numbers combined need to be no more than 110% of the after improved value. So the actual construction costs and the purchase of the property can actually go above current market value with this particular loan. Shaniqua?
Yeah, and the other great thing is understand that you can use a 203K to renovate a duplex too. So when we're talking about finding these you know, diamonds in the rough, sometimes we haven't seen the diamonds yet, but we've only seen the rough, and that is very consistent with a lot of these multi-units that we're seeing these days. But again, you can go put your new and create your own value into your multi-unit. So you're not only increasing the value of the multi-unit, but you're also increasing your abilities to have capital improvement, so you can increase the market value of the rents. But the other piece to that is once you get to the point where you acquired the property, they have a special appraiser that goes out to go and assess the value of the property. And they'll assess it based on the repaired value. So it's not your regular schmegular appraisal. And then there's also a HUD appointed like project manager that's attached to it too. So they keep you to budget. Then they'll help you with the draws. And what are the draws? The draws are the amount of money that you're able to get to continue the scope of the work, because they don't want you to get into the position where you're running the project poor. And what does that mean is you're robbing Peter to pay Paul. So this money is only allocated to finish this job, and it needs to be done, and you won't get any more money until this part of this phase of the construction is done. And so it's great because we hear so much about contractors that are running behind, or they're not running,
running away.
Yeah, they're running away, or they're not doing quality work. And so you have somebody that is actually in your corner, and also in the bank's corner, that is helping manage the project itself. Because guess what? You are typically a first-time home buyer, and you know nothing about construction. So you need somebody else that's going to help you be your fiduciary agency in this process to help move the project along, so you can get it a certificate of occupancy, and then you can move into your renovated property.
Thank you for that. Simone, do we have any other questions?
Yes, we do. I'm trying to go back up to the top. So one person asked, what is it? Wait, is that you, Nikki? Sorry. Talk more about off-market sales and what's the benefit?
So off-market sales, as far as a buyer is concerned or investor, usually an off-market sale is a benefit for an investor because they are basically usually negotiating in some type of distress situation. And what you'll see is a lot of people looking for off-market or pre-foreclosures in order to basically get a deal. If you are on the listing side, I'm sorry, I have both hats. I represent buyers and sellers. So when I'm representing a seller, marketing it off market, there's various different ways you can market off market. It's off market, meaning like they don't want to let people know that they're selling their house because they have an issue and they're looking for someone to bail them out, because then that's a benefit. Versus basically where I can see our market going is marketing it off market for a seller, basically to get a benefit to the realtor, because you get to represent the buyer, the seller. So it's a lot that goes into off market. It's kind of sometimes stingy on the real estate side, but I don't know if you feel the same, Shaniqua, or.
Well, off market, I think people think that they're going to get a whole bunch of deals on off market, right? But what I think that the benefit is you're not necessarily competing against several different offers. I think that's the biggest asset in an off market when it comes to a buyer, is how, again, we're always talking about leverage. How can I get leverage in this offer process too? And being able to get into a place where you're not non-competing against other people and not exposing yourself to other offers that may have more of a down payment or may come in stronger with cash, is definitely going to be a benefit for a buyer. Now, does that happen often? Not really. Most houses are sold on market, to be honest. We do see a lot of properties that are being marketed off market, but they're like a day away from getting to the active market. And here recently, there has been guidance from the National Association of Real Estate, National Association of Realtors, where if we start promoting something as off market, within 24 hours, it has to hit the market. That's really kind of drying the off market inventory up, because we just don't have the ability to kind of flex in an off market space anymore without there being some type of compliance. But I mean, it happens. I just closed on a duplex that was off market, but it is not very common.
And usually when the seller has a property off market, they are expecting usually a quick close. So they're usually expecting some type of cash offer and not waiting your typical 30 days for your mortgage loan to close. Because if that was the case, then they would open it to the open market. So usually they want a fast close, they want all cash, they want to work a deal.
All right, cool. Next question. What is the difference in 100% financing through a credit union and a program like ours that has a first-time home buyer program?
Do you ladies want to comment, or I can start off with that?
Yeah. I'll let you start off, but it's funny because I was having a conversation earlier, and perception versus reality is very interesting. You'll hear someone say, "I got a no money down loan," when really it was layered financing of down payment assistance, seller credit, lender credit, a gift, and at the end of the day, it was no money down.
Yeah.
And sometimes more expensive at the end of the day.
Yeah.
Yeah.
Yeah, and I was going to share that yes, as homeowners advocates, we're saying we're changing the narrative. You don't need 700 down. You don't need 3.5%. Get in where you fit in, all of that. But not to negate the fact that, yes, you want to have the best credit because you will get the better interest rate. Yes, the more money that you can put down will possibly put you in a better position of also interest rate and terms of the loan. As it relates to down payment assistance, not all down payment assistance is free. Many of them will have silent seconds. So what that means is, if it's not a grant, it means that at some point you're going to have to pay it back. And typically that means when you sell the property. Now, when you're in this sexy transaction, you forget that in the 152 pages that you signed on 2 or 3 other loans. So you get ready to sell your house, you bought it at 150, it's now 300,000. You think, oh my goodness, I got $150,000 worth of equity. You forgot that there were 3 loans that got you there, and you may be at 0 equity. So again, these programs aren't bad. You just need to understand what you have and what the impact will be, so that you're not surprised at the end of the transaction, and that you're clear of what you are utilizing the tool and asset to do for you. So to answer the question, I'm always sensitive to say there's nothing bad or good, just depends on what you're trying to do, what assets and resources you have. Most banks typically all operate in the same type of universe, so the programs are going to be very similar, but that's where, again, we're here to help solve for you what program would be best.
Yeah, Nikki, I'm so glad that you brought that up, because I'm not opposed to using down payment assistance program, not one bit. Let's make sure that we're saying this. But you do have to understand what's going on in the fine print, and make sure you remember what's going on in the fine print, because you get in your house, you get the keys, you do your wonderful sold photos, and then you have the housewarming, you have all the stuff that happens, and then all of a sudden 5 years later, 3 years later, 7 years later, you go to sell your home, and all of a sudden you go, oh, I found out that I have this amount of equity, and then you go to sell, and then it's like, pause, I got to pay what off first? And I have that happen where I had a client whose family sold the mother's home in East Oakland, and they didn't realize that she had an equity share attached to her home until the escrow company pulled all the liens on the property. And guess what? It was a 49% equity share. But those were very common in the 80s. Mm-hmm. And but the great thing in this is there was tons of equity in it. So they didn't lose out, totally, but there was a chunk of change that they had to give to the state of California. And I was like, I didn't even know the state of California was in, down payment assistance or home buyer assistance programs, but at one time they were. And it cost them dearly, but it allowed them to get into a home that could appreciate over a long period of time, and they still were able to walk away with 6 figures each because of the amount of equity that was in the property. So it's not horrible. You just have to know exactly what you're dealing with when you get into these programs.
Would you suggest a first-time home buyer to consider purchasing a home in disrepair? And I think you guys were going through this earlier as well.
Yeah, I think we addressed that one. Nikki did. Yeah.
Sorry. Do you get financing from multiple people if you do FHA or one company? Did we go through that one?
No, I know. I'm wondering if the question is, should you shop for multiple lenders? So again, not to make this be an RNHS commercial, but this is really where we can assist with the legwork. I think the conversation was earlier, you can go to where you make your deposits every day, or every month to your bank and say, hey, I want to buy a mortgage. they're typically going to only have one, suite of services for you. So they may have requirements you don't meet. You walk out thinking, I can't buy a home. When you work with agencies like ours, or those realtors like we have today that are invested in the process, it's our job to know who's doing what. So if you come to us and we understand where you are, we might say, these are the 3 lenders that we think is most appropriate of what you're trying to accomplish. So you're not going to bank to bank to bank. And the other piece of that, where we talked earlier about a pre-approval versus a pre-qualification, in this current condition, a pre-approval means you pretty much go through the underwriting process and they have stamped the approval to say, if you find a house, we'll give you a loan. Prior to a pre-qualification, which is based on what you told us, we haven't really seen anything, but if everything you tell us is true, we can approve you for this. Now, what would be the impact if you went to 5 different banks and got pre-approvals? Well,
Yeah,
since I can't see you, what do you think the
yeah,
impact would be, realtors?
yeah. So
I have a question to the chat room, sorry.
Well, the impact would be your credit is hit. And depending on what your time frame is, we know that credit inquiries can impact your credit score. So you don't want to be shopping bank to bank to bank, especially if there's going to be inquiries on your credit report. And we can do a lot of that legwork without you ever filling out an application.
Another question is, while I understand that this is not the housing bubble of 2008, do you believe the current high unemployment rates will lead to increased foreclosures or increased short sales in the near future? She said that they said that they're currently seeing decreases in the prices homes.
I'm not seeing decreases in the price of homes. I'm seeing the decrease in the maybe listing prices of homes to encourage people to get out of their shells and their shelter in place and get out and purchase. I was just looking at a report yesterday. I don't know what city it was in, but it was in the Bay Area where it was like one community, all of the properties, I wish I could remember where it was, but they were all listed at $499, and then they also sold for like $650,000, $700,000. So when you see the prices drop, you have to also think about the psychology of the area, the psychology of what's going on in the market. So as real estate agents, we are also, when we sell properties, we are in marketing. And so part of marketing is to understand the psychology of your client and the client base, your consumer base, to get them to shop. So if I see that no one is coming out to my property, this is not me, but if I see people not coming out to my property, or I'm not getting the traction that I need on an open house, then I'm going to start my listing at a really low price, get a lot of people in, a lot of action going, and hopefully I can get a bidding war going to make something happen. And so also when you think about unemployment rates, you also have to really remember that before COVID went into place, they were also talking about us having low unemployment rates before. So are we actually just basically evening off or tapering off to where we were maybe 2 years ago? So it's to be determined in my eyes.
I honestly don't think the unemployment is going to be a big factor in the housing crisis and where we're seeing with housing. It's not going to create a crisis, I should say. And let me explain to you why. It is my opinion that a good majority of the people who were unemployed probably couldn't afford to buy a house in the San Francisco Bay Area to begin with. That is an unfortunate byproduct of what we're seeing with housing in the San Francisco Bay Area. Where I do see that there is going to be a squeeze is when we're telling multi-unit owners that renters cannot afford their rents. That is going to create a different dynamic, and we'll probably see more multi-units going to the active market because people are not going to want to deal with the tenant protections that we're starting to see emerge in all of these cities across the 7 counties of the Bay Area. So I think that it's again, it's going to create some collateral damage somewhere. We just don't know where. I'm thinking that it's going to be in the multi-unit space, but at the end of the day, that could create opportunity for people who are first-time home buyers that want to go in and get these properties and offset their mortgage and not have to be exposed to the rental market as we've been seeing. But no, do I think it's going to cause a mass exodus of people that need to that are going to get foreclosed or going to need to short sell? No, I think there's many people that have a lot of equity. I'm hearing that the banks have put guidance in a lot of their refi programs so that if they see that somebody has refinanced in the past 6 months, or if they've seen that they're refinancing several times, then they'll basically say, no, you're not a good candidate to get refinanced. So they're putting the brakes on people using their homes as credit cards. And it's funny how people forget what happened in 2008 when they start seeing low interest rates, because they're like, hey, I can refinance again. Like, no, you can't. And you can't. People like to gamble with their properties, and that's an unfortunate place to be. But we do see some of that, but I don't think that we're going to see a huge amount of people that are going to get into foreclosure. Now, where do I do think that we will see the foreclosure? I think, unfortunately, this is going to hit our senior community very hard. I do think that it's going to hit our community that have multi-generations and may have seen income loss somewhere. I think we will see certain segments be more effective than most, but will it be a wide range of opportunity in the foreclosure and short sale market? No.
You know, what's also interesting, and I thought about this when I'm seeing all of the commercial buildings going up in the East Bay for rent. And it's just amazing how all of these buildings were approved to build for renters, but none of them were allowing condos to be purchased. So it wasn't for home ownership. It was actually for these commercial builders to make money off of the tenants that would rent at $3,000 to $5,000 a month. So in my little crystal ball, I'd like to see a condo conversion take place for some of these large commercial buildings that see the economy taking a shift, do a conversion from rental units into condo units and allow more home ownership in the East Bay. So that's my little wish.
Maria, I can see that happening, and as developers, we understand that there's capital stacking. So when you get approved for these deals, you're anticipating, estimating, or guaranteeing certain income levels to offset debt. And if people aren't able to pay, they are going to have to be creative. And I could definitely see that happening.
Well, I mean, we're starting to see it with some of these new developments, like in downtown Oakland core, which, I can go all day about what the city of Oakland isn't doing.
Mm-hmm. I do want to do a time check. We're at 5:18, and I know we're having a number of questions coming in, which I think is awesome because it's definitely stimulating the conversation. So I want to make sure we get through all of the questions. So Simone, and as Simone is filtering them, because I know they're like popcorn, are there any final comments that you guys have had relative to this conversation that you want to get out? Because I'm going to assume after we get through questions and answers, we'll be done with our time today.
Yes, I just want to encourage everyone to stay positive in this housing market. Now is the best time to work with an educated real estate professional that can guide you through the home ownership process, guide you through the market, and educate you throughout the home buying process on the property. I think now more than ever, people will be paying more attention since they can't walk through the property readily and just fall in love. They'll start looking at the things that are really important through the transaction that sometimes don't have enough attention, and that's things like the home inspection and the marketplace. What you'll see more, because we have to market virtually and not in person. If you go through an open house, you just have someone standing there that may not be sharing a lot of information with you. Now to market the house, you'll probably see more real estate professionals educating you on the school systems, the neighborhoods, where the community is going in the next 10 to 15 years, as well as the bones of the house. And because if we're online and we're virtual, we can't just sit here and stare at you and say, look at this house, right? We have to educate you. So I am encouraged that you'll be educated more through professionals really getting information out about the property to help you make the best purchase decisions.
Well, I have to say that I'm really excited about the amount of people that are taking the shelter in place as an opportunity to get educated about things like home ownership and real estate investing. I can't say that I've been any more busier.
Right.
And it's great because people, let me tell you, when I got into this business 15 years ago, we didn't have the internet. We didn't have all of these abilities to get as much information that you could and can. And the fact that you're using that as a point in time to leave this quarantine better than in which you arrived is absolutely amazing to me. And I do recommend that you don't do this alone. Make sure that you are working with a real estate professional that's going to help you all of the information and get you into an intentional search that's really going to work for your benefit. Because at the end of the day, when you're getting into these places of buying properties, you're not buying a home. You're not buying something that's right now. You're buying something that is going to benefit or impact people that you haven't even met yet. That's what generational wealth is about. You're putting yourself in a position. You're putting your children, your family in a position that is going to create opportunities that your ancestors would have never believed that you have the ability to do. So if anything if there's ever time to move in real estate, now is a great time to do so, especially with the interest rates being so low.
And I just wanted to share you guys' contact information before it gets too late. So I'll put Ria's up first.
And while you're doing that, Simone, I'll help you with the questions.
Thank you.
The question is, what is my screen?
You're gonna see our pre-COVID shots.
What loan qualifies for multi-unit as a first-time home buyer with a score of 680 or more?
FHA all day.
Yeah, and most lenders will have this program. It's not, unique or different under the Community Reinvestment Act. As I mentioned before, these community lending programs do have multifamily units, so it's not something that's unusual to talk about. There was a question about, should you, as a first-time home buyer, should you buy a house with a big lot in the back so that you can develop? I'm going to just share my 2 cents. As a first-time home buyer, I encourage you not to buy a project if you can, because there is so much just to learn in being a home buyer before you take on too much. So again, it depends on your situation, your support, your financing, your ability to, transition a property. But I think the first point is just understanding what you qualify for, managing your expectation of your affordability, where you can live. And I'm sorry not to make this fast, I gotta say it. Your lender is going to qualify you on your gross income. You live on your net income, so that's a significant difference. So even though you might have a piece of paper that says you qualify for 600,000, really in real life about $500,000 is really where you can feel most comfortable with. So there's a lot to kind of dissect and pull out to determine really what program is going to be best for you. There's a question, if you're from San Francisco, but in general, GA for, that was funny, GA for a moment, any assistance down here? So when you say GA, I'm going to assume general assistance. It's Depends on
No, Georgia.
San Francisco, but in Georgia. Oh,
Georgia.
got it. I was thinking about the Section 8 program, because you can't get a home if you're on Section 8. Okay, so I'm sorry, it flipped on me. I'm from San Francisco, but in Georgia for a moment. Any assistance down here? So we primarily focused on in California, but pretty much everything that we're saying here at the institutions and the banks that we work with here are there. They're typically going to offer the same, but typically down payment assistance programs are going to be based on cities and counties. We just wouldn't have that information available for Georgia. Be happy to help you. Organizations like us do exist in other parts of the country that we have networks with, so we could definitely get you connected.
That's a common one. I have my actual best friend. She just moved to Atlanta, so she's in that process right now.
Thanks, Brandon, for understanding the humor. Let's see what else. Simone, am I missing anything? I'm scrolling. I just want to make sure we get everything in.
Someone asked about jumbo loans.
Do you guys want to talk about that?
They took a shift.
Yeah. Yeah.
After the last couple of months, I actually I have a fourplex that actually I got a text saying the docs are going out right now while we're on this call. But when we first were out looking at the properties, guidelines were very different. And then soon as the shelter in place hit, a lot of your banks guidelines had changed. So where you would see a 25% down payment, they went to 35% down. And basically they were acting in a way where they were protecting their assets. And so I probably had to call about 15 lenders before I found someone that could still meet the guidelines pre-COVID. So, and also with jumbo loans, the debt to income ratio, so your debt versus your income is a little more strict and rigid than what you would see in a conventional loan. So that's something to take in consideration too. With your jumbo loan financing. And then we're also seeing a re-entry of first and seconds with jumbo loans. So a jumbo loan is usually a loan amount that exceeds the conventional loan limits for your particular county. So when it exceeds that, it's considered a jumbo loan. And in the past couple years, it was less likely for you to get a first and second loan combined to break out, so that the first is conventional and has a little more flexibility and guidelines. And so we're seeing a re-entry of that, which are allowing lower down payments for your jumbo loan. So I've seen as low as a 5% down loan for a jumbo loan. That definitely went away when COVID hit. And unfortunately, this particular loan was for a new development. And so the hopes is that they will increase their assets or have some type of guideline change come the completion of the actual project.
Yeah.
I'm sorry, go ahead.
March 2020, it was not as big of a party when it came to lending. It did. COVID-19 definitely, if it affected anything, it affected the jumbo markets. That was what gave me a little bit more concern, because we have because of our values. That did concern me. So it's really it is. I'm happy to see that we're starting to see them reemerge for sure, because we don't want to stifle the credit, the flow of credit or financing in a market that could definitely stifle the resilience of a market for sure.
And I want to get in one last question before we go, because two different people asked this. Wondering if you are a first-time home buyer and receiving unemployment due to COVID-19, can you still be considered, I guess, to purchase or to still be a first-time home buyer?
That's going to be a challenge. So what lenders are also doing, and because of the employment numbers, they're actually going back and they're kind of back to you to see, if there's going to be an issue with you being employed after the loan. So if you're not employed and you don't show income, you're not going to be able to get a home loan. And we actually were working with a client that was right in the middle of closing but lost their job, and the whole loan fell through due to COVID. So what I would say, however, if you're unemployed but you quickly find another job, same industry, same type of job, you're not going from a teacher to a construction worker, there's possibly a savings grace there. But if you're unemployed, then the likelihood of you being qualified right now is highly unlikely.
Yeah, I would agree. I mean, you are technically getting a benefit for people that are saying that we are unemployed. So the whole, one of the things that they're going to look for in the application process is your ability to have income coming in. What is your capacity? That is one of the C's that they're looking for. What is your capacity? Now, you know, if you're furloughed and you have the ability to go back to something, then that's one thing, right? If you're able to show the underwriters that you do have a re-entry plan into your position, that's one thing. But for the most part, it would be really, really challenging to be able to use unemployment income to get approved for anything.
Right, and I'd also encourage that don't get discouraged too if you're going back into the workforce, but you've had a period of unemployment, don't get discouraged. A lot of people think that if they don't have a consistent 2-year employment history that they can't qualify for a mortgage, and that's not true. If you have short terms of unemployment, there could be some what they call loan underwriting conditions where the underwriter wants you to explain what that gap in employment was related to. And if you're back gainfully employed, then they will take that in consideration. So don't think that this time of unemployment is stifling your goals.
Well, thank you for
Same goes
that.
for disability too.
Yes. Thank you for that. I'm hoping we got all your questions. If we did not, please find us via email. I think we've all been engaged that way. We will get the answers to you. We will also share Rhea and Shaniqua's contact information so if you want to have a more direct conversation. So final thoughts, our Lender Ready program. If you want to explore this deeper, the way you work with us, you complete an application for us, we gather all the documents as a lender would, we do your affordability, your debt to income and all of that, and kind of pre-underwrite you. And then say, based on what you've told us, this is what you qualify for. And based on our relationships with banks, these would be the institutions we think you should submit an application to. And what our arrangements with those institutions are, they will take a look at everything we've gathered and says, yes, this looks really good. I think you should go to application. Are there some things that we need to work on? So we help you through the process till you get your keys. And because of that Lender Ready program, last year we got over 28 families into homes. Numbers might be a little different now because, thank you, because we haven't been as active. But even though we're in COVID, we're doing everything remotely. So whether it's a Zoom call, over the phone, email, we're here to assist. The other thing is there was a lot of questions about multifamily units. On May 28th, next week, we're going to have Steve Peterson talk to us about real estate investing 101. So if you really want to unpeel what it means to be an investor, but I have to say, in these times, there is no easy feat to be a landlord. So you have to be committed to the obligation you have to your tenants and understand the city, county, and state's requirements of your responsibility as a landlord. And then lastly, if you do want to take this journey in home ownership, we are starting our virtual our HUD-approved pre-purchase workshop series in June. It's going to be every Thursday from 4 to 6. We're breaking it up over 4 weeks because if we could see and touch each other, it would be an 8-hour course on a Saturday. So we've broken it down. So if you want to start this journey, that's a great way to go because it allows us to really get you to understand what the whole process is. So we appreciate your time. Thank you for being with us, and we hope to see you next week.
Thank you.
Thank you, ladies. You did a phenomenal job. I appreciate all that you've shared with us this evening.
Thank you for having us.
Yeah,
Take care.
you. Bye.
Stay healthy,
Bye,
stay
Shaniqua.
safe, stay in place.
Bye.
Bye.
Bye.